We are going to start with the relative valuation models. Till last lecture, we saw cash flow based models. We have discussed relative valuation models concepts in the last lecture itself. Today, we'll see the questions of relative valuation models. Okay, so how it is, we'll see. Question number 16. A Limited made a gross profit of 10 lakhs and incurred indirect expenses of 4 lakhs. Okay, the number of equity shares issued is 1 lakh. Okay, so by this information, what we are getting is that GP is 10 lakhs. Okay, minus 4 lakhs, so 6 lakh is your EBIT. Okay, so gross profit minus your indirect expense, you will get EBIT. And number of equity shares is given. The company has a debt of 3 lakh and surplus funds cash to the tune of 5 lakhs. Okay, the company has a debt of 3 lakhs and cash as 5 lakh. Okay, so this will be used to find out the value of the firm. Okay, what is value of the firm? It is equity plus debt minus your cash and cash equivalent. If it is asked in the question, we'll solve it. Okay, market related data are given as below. Okay, RF, RM minus RF, beta of the company. Okay, so this is used to find out the market return. Okay, KE of the equity. Okay, so 12 minus 4.5, okay, 7.5 into 0.9 plus 4.5. So it is 12.25 we are getting. 12 minus 4.5. So 11.25 is the KE. Okay, we have also got KE. Okay, now what you have to find is determine per share earning value of the company. Okay, per share value of the earning value of the company means what? Per share earning value, EPS or what? Let's see. Okay, so 10 lakh was the gross profit minus 4 lakh, 6 lakh is EBIT. Okay, the company has a debt of 3 lakh. Okay, so what is the rate of return here? What is the interest percentage here? There is no tax given here. Okay, so we have to find out interest. Can we use anything here? No, there is no interest given here, but here risk-free rate of return is given here. So we'll assume 4.5% as the KD. Okay, so 3 lakh into 4.5% minus MRC. Okay, so 586, 500 is my PAT. Okay, since there is no tax, we'll move on to PAT only. Okay, now divide by 1 lakh equity shares. I'm getting it as 5.865. Okay, $11.25 was right. Okay, 11.25 we have already found out. Per share earning value of the company. So GP minus indirect expense they have done. Okay, profit they have got. But why haven't they used this? If you take RF, if you have written that assumption that the debt has interest of 4.5%, assuming that risk-free rate of return is the company's debt, okay, the company would also have been paying that much, then we can do it. Okay, but here they have not done it, so directly they have directly taken earning value of the company. Okay, they are doing it by earning based model. Okay, so 6 lakh divided by how much? 11.25%. So they are getting it as 53 lakhs 33,333. Okay, so divide by 1 lakh. So per share value is 53.33 rupees. Okay, they are using earning based model. They are asking us per share earning value of the company. Just keep that in mind. Okay. Next we have is equity value of the company. We'll write it here. Okay. Not to take risk free as debt interest. Use earning based model. Okay. Equity value of the company, if applicable, EBITDA multiple is 5. Okay. We have to assume profit as EBITDA. Means what? 10 lakh minus 4 lakh. So it is 6 lakh is the profit. Okay. The EBITDA multiple is 5 of the similar company. So into 5. It is very much easy. What have they done here? Equity value of the company, if EBITDA multiple is 5. EBITDA multiple is 5. Enterprise value is equal to EBITDA into EBITDA multiple. Right? This is the formula. Now what is EBITDA? 600. Okay. Into 5. Okay. So we are getting how much? 30 lakhs. Okay. 30 lakhs we are getting as the EBITDA multiple. Okay. Now value of equity out of this is how much? Okay. So what is enterprise value? Enterprise value is your equity plus debt minus your cash and cash equivalent. Okay. So minus, if I want enterprise value, minus debt plus cash. Okay. Minus debt is how much? 3 lakhs plus 5 lakh. So it is 32 lakhs. My equity value is 32 lakhs. Okay. It was a good question if you understand the concepts well. Okay. If you have known the concepts, you would have able to solve it. Okay. So I'll just show you the concepts here. Business valuation. They have used what? Earnings capitalization method. Okay. So capitalization, you have to do capitalization. Okay. Value of business, earning value of the company. This is very, very much important. Okay. Earning value of the company. This, if anytime they would have asked in question, earning value of the company, then we have to find out earning, and then we have to use earnings capitalization method and find out the value, earning value of the company. Okay. Earning value of the company. Next, they have asked us is question number 17. There is a privately held company, X Private Limited. There is a private limited company called X Private Limited that is operating into retail space and now is scouting for angel investors. Okay, so it needs funds. The details pertinent to the valuing X Private Limited are as follows. The company has achieved break even this year and the EBITDA is 90. Okay, break even means no profit, no loss, and has an EBITDA of 90. Okay, rupees 90. EBITDA per share is 90. The unleveraged beta. Okay, what is unleveraged beta? It is your equity beta. No, it is your we already have it in the notes. Okay, we'll just quickly glance through it. It is in portfolio chapter. See, asset beta. Where is my asset beta? Asset beta, see here, this is the asset beta, right? So asset beta, equity beta, also known as stock beta, levered beta or geared beta. Okay, equity beta is called as levered beta and debt beta is called as unlevered beta. Okay, debt beta is also called as unlevered beta, so keep this in mind. Okay, why is it called as unlevered beta? Debt is called as unlevered beta because it has no risk. Okay, the unlevered beta on the industry, unlevered beta means your debt beta, and the average debt to equity ratio is hovering at 40:60. Okay, which means what? For 1 lakh 40,000 will be your debt and 60% will be your equity. 60,000 will be your equity. The rate of return provided by risk-free liquid bonds is 5%. Okay, so RF is given. The EV is to be taken at a multiple of, enterprise value has to be taken a multiple of 5. Okay, the accountant informed that the EBITDA is 90, includes an extraordinary gain of 10. We have to reduce it, and potential write-off sales promotion cost of 20. Okay, so we have to deduct it. Okay, the internal assessment of risk, the internal assessment of rate of market return for the industry is 11%. Okay, market return is 11%. The FCFs for the next 3 years are given below. Okay, the pre-tax cost of debt will be 12%. Okay, so what is the after tax? It is 12 minus 30%. It is 8.4. What is the potential value to be placed on X private limited using following methods? That is EBITDA multiple method. What is this? It is very much easy. So what we'll do? It is 5 into your 90. Okay, 5 into 90. Not exactly 90 because 90 includes extraordinary gain. So 90 minus extraordinary gain of 10 and sales promotion cost, it is to be written off. So 20 is pending. So 20. So 60 into 5. So 300 should be my rupees 300 should be my EBITDA of the company. Okay, so 300, right? This is very much easy. Next we'll do FCFF method. So in FCFF method, what do we need? We need first cash flows. Okay, into we have to discount it. For discounting, what we need? For discounting, we need KO, right? So to find out KO, we need to find out KE first because KE is not given in question. So to find out KE, here unleveraged beta is given. Levered beta is equity. So unlevered beta should be debt. Here they are given unleveraged beta. Means what? Leverage means what? Debt. Leverage means debt. Okay. So unleveraged means what? It is your equity. So equity beta is given here. Sorry, I made a mistake. Okay, it is equity beta. Okay. This unleveraged beta is equity beta. So my market return is how much? The market return is 11. 11 minus 5 into 1.8 plus 5. Okay, my KE is 15.8. My T is 8.4. Now we have to find out weight. Okay. So weight is how much? Weight is 40 is to 60, right? So into 60 divided by 100, 8.4 into 40 divided by 100. So I'm getting it as 12.84 as a KO. Okay. So KO is 12.84. What is KO? Why are they giving a... Wait a second. It is not 12.84. Wait. The levered beta of the company will be 1.8. Now in this question, they have given us asset beta and not... They are given us asset beta and not beta of equity. Okay. So what is asset beta? Asset beta is beta of equity into weight of equity plus beta of debt into weight of debt. Since beta of debt is not given in question, we'll assume it as 0. Okay. So debt equity is equal to 40 upon 60. So debt is 40, equity is 60. Okay. Now we'll calculate weight of equity. This is very much important. So weight of equity is 60 divided by 60 plus 40 into 1 minus 3. Okay, 40 into 1 minus 3, because while calculating asset beta, okay, we'll take tax effect on the weight of the debt. Okay. So it is 0.68 and weight of debt is 0.32. Okay. Now we put it in the equation. Weight of equity is 0.68 and weight of debt is 0.32. So 1.8 was the asset beta. So beta of equity is 2.65. Okay. Now this one is very much important. Okay. This point. The unleveraged beta based on the industry. So this is given as asset beta. Okay, and not beta of equity. Okay, so asset beta is given. We have to be very much careful. Okay, so that's why we are getting answer as 2.64 as a beta. Okay, so 11 minus 5, 2.64 plus 5, it is 20.84. Okay, into 60 divided by 100, 8.4 into 40 divided by 100. So I'm getting it as 15.86. Okay, now we have to discount it. Okay, just keep it in mind. The unleveraged beta based on the industry in which it operates. Okay, so asset beta is given here. Okay, and not beta of equity. Okay, just keep these words in mind. The unleveraged beta based on the industry in which it operates. Okay, based on the industry means what? Asset beta is given here. Next, this is a question reading mistake, so keep that in mind. Question number 18 is a nice question, but it is very much easy. We'll see what it is. XY Limited, a cement manufacturing company, has hired you as a financial consultant of the company. The cement industry has been very stable for some time, and the cement companies SK Limited and AS Limited. Okay, so XY is R Limited, R company, and SK and AS are similar companies. They have similar size and similar product market characteristic. Okay, it is a similar company. Using comparable companies method to value the equity in performing analysis, use the following ratios. Okay, market to book value. We have seen this CCM method. Okay, market value to book value, market value to replacement cost, market to sales, market to net income is given. So we just have to take average of these first we have to take market value to book value of both these companies and average it out. Okay, average is the ratio. Okay, and then we'll calculate our this thing market value using the four things. Okay, and we'll get our market value by dividing all these by 4. Okay, so we'll see how it is done. So first, market value to book value of SK Limited. So 450 divided by 400, and for AS Limited 400 divided by 300. Okay, so average is 1.229. How is average calculated here? It is 1.125 plus 1.333 divided by 2. Okay, so 1.229. Like that you have to do for everything. Okay, and then our book value, that is 250 into the average, we'll get an amount. Okay, so total all this, it is coming to how much? 307.25 plus 369.5 plus 427 plus 350 divide by 4. So 363.44 is my average value. Okay, so this is very much easy, you can do it yourself. Next we have question number 19. Here learn format is given. Okay, so what it is, we'll see. This is a chop shop approach. Okay, assign the value of Cornet GmbH. Okay, this is a company's name whose stock is currently trading at a total market price of 4 million. Okay, total market price of 4 million. So market cap is given, I guess. For Cornet, the accounting data set forth in 3 business segments: consumer, wholesaling, specialty services, assorted centers. Data for the firm 3 segments are as follows. Okay, so segment sales is given, segment asset is given, segment income is given for consumer, wholesaling, specialty services, assorted services. Industry data for pure play firms have been compiled and are summarized below. Okay, what is pure play firm? It is similar firms. Okay, so capitalization to sales directly it is given. Consumer, wholesaling, assets is given. Okay, so we have to use this and multiply it with the segment sales. Okay, now how we'll do it, so we'll see. We'll calculate first for segment sales, segment assets, segment income for every business segment. Okay, so segment sales is our main head. Okay, segment sales, how much is it coming? Total segment assets, how much is coming? So total segment income, how much is it coming? And divide by 3. Okay, we'll get the theoretical value, sorry, your market value, enterprise value of the thing. Okay, so divide all 3, divide by 3. Okay, so first segment, business segment and capital to sales. Okay, business segment I have written here, and sales first one. Okay, capital to sales is how much? 0.75, 1.10, 1.1. Okay, into my segment sales, everything. Okay, so I'm getting value at 40.05. Okay, now next for next we'll take the same business segment, but here we'll take capital to assets. Okay, segment assets will take. Okay, for assets value is given here, and business segment to operating income. Okay, operating income, that is profit, is given here. So ratio is given, so multiplied with the segment income we'll get the values. So take all total figures, divide by 3, we'll get the answer as the enterprise value. Okay, this is chop shop approach, you have already seen it. Okay, so this was it for relative valuation method. It was very much easy. Okay, just one question we had some doubts. Okay, which is this question number 17. Okay, and question number 16. Question number 17, what we had, question number 16, and question number 17. Okay, so what we had is it that here we had to take what, not to take RF as debt. Okay, so we should not consider debt here, we should take whole profit as the earnings. Okay, we should not deduct debt. Okay, they are giving debt for free. Okay, there is no interest given here. Okay, so divide by earning value of the company, that is KE. Okay, we are calculating earning value per share. Okay, so this is very much important. Okay, this was very much important. We are calculating earning value per share. Okay, in question, per share earning value of the company is given. Means what? Earning value per share. So profit attributable to shares. Okay. It is all fair only, but they have not given us interest rate here, so we will not assume RF as the this thing interest rate. But if you would have taken this assumption and written an assumption here, it won't be wrong, I guess. Okay, because RF is given here. If you have assumed that, then we should get marks. Okay, I don't know, but we should get marks. Okay, divide by the KE. Okay, we'll get and we'll get an amount. Divide by number of shares, we'll get the amount. Okay, the second part was very much easy. Okay, it was earnings value. Okay, the first basics of this thing, business valuation. That is, what is earnings value of the company? It is equity plus debt minus cash and cash equivalent. So that is given here, because in question surplus funds were given. Okay, so in any question surplus funds are given, then take it. Okay, in any question surplus funds are given, then use this method. Okay, debt plus equity minus surplus funds. Okay, and question number 17, we had what? Unleveraged beta based on the industry in which it operates. Means what? Asset beta was given, but we mistakenly took it as what? Beta of equity. So keep this in mind. So how we'll calculate this? I'll just write and show it to you so that you will gain better understanding. Okay, so unleveraged beta was how much? 1.8, right? 1.8. So what is beta of this was unleveraged beta of asset. Okay, so weight of equity into beta of equity plus weight of debt into beta of debt. Okay, so what is my weight of debt? Weight of equity. Weight of equity is 40 divided by 40 into 1 minus t. Okay, 1 minus 30%, right? Divided by 60 plus 40. So this is weight of debt. Okay, 40 into 1 minus 0.3. Okay, plus into what? Beta of equity. Beta of equity is not given here. Weight of debt. Weight of debt is, we are taking as ulta. Okay, weight of equity is 60 and divided by 60 plus 40 into 1 minus 0.3 into beta of debt is 0. Okay, so by solving this we'll get the answer. Okay, so 40 into 1 minus 3 is how much? 28 divided by 88 into beta of equity is equal to 1.8. What are you missing here? Achha, okay, this is beta of debt, right? So this is beta of equity. Okay, so it is not 28, it is 60. Okay, 1.8 into 88 divided by 60. So it is 2.64. Beta of equity is equal to 2.64, and we'll use this for finding weight. Okay, so we'll put it in the equation only. Okay, so beta of equity is how much? 2.64 into, what is my weight of debt? It is 60 divided by 88 plus 40 divided by 88 into beta of debt, that is 0 only. Okay, we don't need this, we just needed beta of equity only. Okay, this is the same formula. Okay, we just needed beta of equity for finding KE. So KE is what? 2.64 into 11 minus 5 plus 5, right? So it is 20.84. KO is what? KO is 20.84 into 60 divided by 80, 8 plus 8.4. Here it will come 100 only, because our tax effect is given in the rate of interest, okay, into 40 divided by 100. It is 12.5. It is 3.36. It is 15.86. So 15.86 we have to do PV. Okay, divide by 100 plus 1, 1, 2, 3. Okay, we'll use this figures as the PV. Okay, for finding out PV. Okay, after that, when we find out PV, our question is over. Okay, so this was the main catch of question number 17. Okay, this was very much easy. Question number 18 was easy, and question number 19 is just you have to learn format. Okay, chop shop approach. So we are completing with the relative valuation model questions. Okay, I hope you have understood everything, and next we'll solve EVA and MBA. Okay, it is very much interesting. So I'll meet you in the next lecture. Tata, bye bye.